Have you ever wondered how risky the stock market really is? Many people trust their entire life savings in their retirement accounts, which are usually invested, while other people claim that it's hardly better than gambling. Which one is right? The answer is actually both, depending on how risky the investment is. This video, I'm going to go over 11 different things you can put your money in and talk about the risks and rewards of each. This first one might be a little obvious, but we need to establish a baseline. Cash. Now this doesn't necessarily mean paper money, it simply means any money not currently invested in something else. Cash is great because of its ease of use. You need it in your day-to-day life, which means you always want some available. The question is how much? It's generally suggested that you keep enough in the bank to survive between 6 months and 2 years, depending on how cautious you want to be. Any more than 2 years, and you're probably just letting it get eaten away by inflation. For each of these assets, I'm going to show you its returns from the year 2000 to the end of 2020. There's going to be an average, a minimum, and a maximum for each year. I'm also going to show those same values, but adjusted for inflation. Now please take some of these values with a pinch of salt. I only have access to free resources, and I found that even when measuring the same thing, values differed slightly from site to site. Links to all of the resources I used can be found in the video's description below. Let's get into the numbers. Cash is not a typical investment. It only gains or loses value with inflation. This means that there is no inflation-adjusted return for cash, because it itself is the inflation. The value of cash lost an average of 2.1% per year, making it the worst average of the 11 investments I'm going to cover. However, with a best case of 0.4% and a worst case of negative 3.8%, it's also the safest. There are a lot of ways to define risk, but for the purposes of this video, the investments are considered more safe if they have a smaller gap between their best and worst years, and less safe if they have a larger gap. Now we have our first real investment, 3-month Treasury bills. These are short-term bonds issued and backed by the US government. These are low reward but incredibly safe. So safe that their yield is known in finance as the risk-free rate. When you pay off a credit card or a loan, you build up a credit score, as long as you don't miss a payment. Well, the reason these are considered risk-free is because the US government has been successfully making payments and building credit for over 200 years. These have an average return of 1.7%. This is how much you can get with zero risk. However, once you add inflation back in, the average drops to minus 0.5%. Better than cash, but you're still losing value in the long run. All bonds have a rating from the list on the screen. AAA bonds are the safest and require such a high level of credit that only 2 companies in the US have it, Microsoft and Johnson & Johnson. These are as safe as corporate bonds get. Even though they technically have the same maximum rating that the US government has, these corporations are not able to create their own money supply. This gives them a tiny amount of additional risk because the government can create more money to bail itself out, whereas the companies cannot. This is why these corporate bonds pay slightly more than similarly rated ones issued by the US Treasury. AAA corporate bonds have returned an average of 5.7% over the last 20 years. When you adjust this for inflation, that becomes 3.5%. This is the safest thing I will be covering that has an inflation-adjusted average that will grow over time. To try to put the average return in perspective, if you had $1 million in these, you would take home an inflation-adjusted average of $35,000 per year. Not too bad. Now it's time for the first investment that might be a little bit controversial. It's a type of bond that's either called a junk bond or a high-yield bond, depending on who you ask. These are corporate bonds that are rated as speculative on this rating list. These are issued by companies that have a lower chance of being able to make payments. The lower that chance, the more risk that's involved, and the more risk that's involved, the greater the return potential will be. High-yield bonds have actually done really well over the past 2 decades with an average return of 4.7% and a remarkable best year of 29.2% after inflation. Maybe they're not such junk after all. It's time to move on from bonds and into stocks. This is the safest level of buying stocks that I'll be covering, and so I'm using a group that are known as the Dividend Aristocrats. These are companies that have been not only paying, but raising their dividend every year for at least 25 years. These include many well-known names like Coke, Walmart, and IBM. Because these companies are often both very large and very established, they carry a lot less risk than most other stocks. This select group of stocks has returned an inflation-adjusted average of 8.6% and a best year of 29.1% over the past 20 years. This includes dividend reinvestments. This return is incredibly impressive considering there were 3 recessions in this time frame. However, this return is not without a cost. Their worst year was a crushing negative 24.6%. This is the first of the investments that's likely going to be too risky for some people. Imagine you're 60 and planning on retiring soon. You saved up your whole life and then suddenly you lose a quarter of your money in a year. Now you can assume the market will recover, but there's no saying how soon or fast that's going to be. People nearing or in retirement are often the most risk-averse, and with good reason. However, one of the key points of this video is to show that there are a lot of options and that you can essentially choose your own risk level. If these stocks are too much, you could easily split your money 50-50 between them and some of the AAA bonds to create your own middle ground. The S&P 500 is an index that's made up of 500 of the largest companies in the US. This index is essentially a representation of the market. Buying an incredibly diversified index fund such as this is the most popular way to invest. Now, as always, there are a million spin-off ways to do it. Some people like to add some bonds, some people like to add some international stocks, but in general, if you're saving for retirement, if you have a 401k, you likely already have money in this or something very similar. In the last 20 years, the S&P 500 returned 6% annually after inflation. This rate might seem on the low side when compared to the last two categories, but that's mostly because of timing. From 2000 to 2011, the S&P 500 only broke even because of two especially hard crashes. If the Dividend Aristocrats are the safe side of stocks and the S&P 500 is the average, the small caps are on the risky side. A small cap stock is one with a market capitalization or market value of under $2 billion. Companies that are newer, smaller, and less established have both a lot more potential for gains, but also have a higher chance of failure. Facebook is worth about $1 trillion. Do you think it's going to multiply in value by 10 in the next decade? Probably not. However, a company going from $2 billion to $20 billion, that happens all the time. From the perspective of the investor, the percent gained is the same. Small cap stocks have index funds just like the S&P 500. They have an inflation-adjusted return of 8.6% with a best year of 45.8% and a worst year of negative 40.1%. Bigger risk, bigger reward. If you're on the younger side and willing to take some risk, maybe instead of looking at the companies that have already exploded in value like Apple and Amazon, you could try looking for the next one of those. Unfortunately, from here on out, there aren't nice, clean annual averages for the numbers. They're either nearly impossible to measure or have to be simulated. The remaining three categories of investments are all high risk and should only be used if you genuinely understand them. First up are leveraged ETFs. These are incredibly interesting, and I plan on making a full video about these at some point in the future. Leveraged ETFs use mechanisms beyond the scope of this video to multiply the daily returns of the index they're following by some leveraged factor. The stock ticker UPRO follows the S&P 500 and leverages it by 3. This means that if the S&P goes up 2% in a day, this fund can expect to go up 6%. If the S&P goes down 3% in a day, you can expect this to fall by 9%. You can see how this can get either really nice or deadly really quickly. Leveraged ETFs are relatively new and did not cover the entire 20-year span we've been using, but I did find some data where it was simulated back to 1980. So from 1980 to 2020, UPRO averaged an annual return of 18.8%. To put that amount in perspective, it would take only 27 years to turn 10,000 into a million. It had a single best year returning 118%. That's more than doubling your money. So why isn't every person and every fund throwing all of their money into this? Well, let me introduce you to 2008. The subprime mortgage crisis, the financial crisis. However you put it, it normally has the word crisis in it. During 2008, UPRO lost 97% of its value. Could you imagine having hundreds of thousands of dollars in it thinking that you were going to retire rich and then it's almost entirely gone in a year? Most people don't want to take that chance. Options are also something that really deserve their own video, and there are hundreds of them out there, but here's the simplest way to think about them. They are added leverage to a stock that has an expiration date. One person writes a contract saying that a stock will go up or down to a certain value by a certain date. Then another person's going to buy it. These contracts are then traded like stocks. If the stock in the contract does not reach the price specified in the contract will expire worthless on the expiration date. So the buyer of the contract is risking 100% of the money they paid. In return for risking all of their money, the potential reward is massive. Options can offer anywhere from 2 to 100 times or even more leverage. If that didn't make any sense and you still have no idea what options are, that's okay. Just think of them as leverage that expires. This risk category is called long-term options. When something is time pressured, you're typically going to do better when you have more time. I'm considering any option with an expiration date that's longer than 1 year away as long-term. These still carry a massive risk and potentially massive reward, but they can be used pretty responsibly. Short-term options are a lot like long-term options, except they're done over time frames that are less than a year long and often only days or weeks long. With the chance to lose 100% for the money you invested in the matter of weeks, the rewards have to be potentially huge or else no one would ever buy them. Some people do genuinely use these as a form of gambling, while others make a living trading them. If you want the adrenaline rush of your money getting cut in half and then tripling in the matter of hours, these are for you. The last item on the list is acting in a very similar role as the first. It's the other extreme. Cash is incredibly safe and stable, whereas lottery tickets are essentially throwing your money away. Your odds of making a positive return are tiny, but your leverage could be in the millions. This is the only item on the list that doesn't have any real investing use. I simply wanted to add it for the sake of going from one extreme to the other. If you were following the list and waiting for something that suits you but haven't found it yet, you've probably gone too far and should turn back now. I think this list was relatively comprehensive, but I will mention that I did not cover futures contracts, forex, or cryptocurrency, among others. All three of these things are ones that I wouldn't be able to reasonably give an annual average return to, so it's hard for me to say where they would fall on this list. I really hope this video helped you put some perspective between the different types of common investments and their associated risks and rewards. I know I didn't cover everything, but the general idea is that you can select any level of risk you want. You want to just beat inflation? There's a thing for that. You want 8% per year to retire at 50? There's a thing for that. You can select a return goal or a maximum risk and combine these assets together to get that. Or you can put your life savings on a single short-term call and roll the dice. I don't judge. Thank you so much for watching. Links to all of the data sources are in the video's description below. If you enjoyed it and want to see more, hit the like button and consider subscribing.